With one quote, JP Morgan's Jamie Dimon created a mini firestorm of sorts when he said basically what everyone is already thinking. On yesterday's earnings call for JP Morgan, the chief executive said, "I probably shouldn't say this, but when you see one cockroach, there's very likely to be a lot more of them." And he said that in reference to the bankruptcies and First Brands and Tricolor. We're all supposed to just pretend everything is just fine. Meanwhile, markets are flashing from gold to credit, interest rates, and even oil contango, as I pointed out yesterday. But unlike Jamie Dimon's all too frequent inflation predictions, this time he has quite a bit of backing behind him. Not just plain common sense, which Dimon added when he expounded further on cockroaching, but also in these markets. Just look at the equity performance of the biggest names in private credit. There's a lot more than a little bit of smoke billowing up from there. Why is gold soaring? It is not inflation. Not with the copper to gold ratio setting a new and even more mind-blowing record low today. That is unmistakably deflationary. Same with WTI now in contango. That's a mix of demand fears combined with monetary difficulties. Over in the bond market, global rates are making what sure look to be the next step down, with front ends on those curves making huge moves this week, especially Germany's 2-year and also the Swiss 2-year, which suddenly dropped even more sharply negative. And it's not just about trade wars. These are decisively not inflation signals. They are instead consistent with a major downturn that might go way beyond simply rising unemployment. I mean, even Jay Powell yesterday referenced the beverage curve. We all know that there is a lot of risk-taking going on over the last couple of years, especially in private credit. What everyone is trying to figure out in some ways desperately right now is how stupid it really got to be, especially now that Jay freaking Powell is referencing the flat beverage curve. So a little bit more on JP Morgan and Jamie Dimon from Bloomberg. On JP Morgan's earnings call, Dimon narrowed in on some of the risks from these non-bank lenders. If the economy starts to falter, there could be, quote, higher than normal downturn type of credit losses in certain categories, highlighting business development companies. Dimon did a popular fund structure for housing private credit. And yes, he may be dinging competitors because that's what Dimon is truly good at. Anything that might help out JPM. And I've argued before that's the whole reason why he keeps spouting off on tariff inflation, trying to create an opportunity in government bonds so his bank can buy a ton more cheaply. However, in this case, what he's saying is what everyone is already thinking. We have seen this before. For years, everyone said the economy was solid. Powell said it. The stock market allegedly priced it. And on top of all that, when the money is rolling in, there is every incentive to overlook all the contrary evidence. Rationalizations get to be just that pervasive. And at this point, we all know what bubble thinking looks like because it looks exactly like the cockroaches Mr. JP Morgan is referring to. And the markets appear to agree. And in response to Dimon's remark, one of the co-leaders of one of the biggest names in business development companies and private credit immediately and aggressively pushed back against them. Banks might want to look at their own books for any, quote, cockroaches, Blue Owl Capital's co-chief executive officer Mark Lipschitz said on Tuesday, standing in fierce defense of private credit. Tying private credit to the fallout from the bankruptcies of Tricolor and First Brands is an, quote, odd kind of fear-mongering, he said at CAIS Alternative Investment Summit in Beverly Hills. Quote again, we're not seeing rising defaults, we're not seeing companies struggle. Yeah, about that. They're not seeing rising defaults and hardly anyone believes what they're saying or what their numbers are. I've talked about this before and really recently, how shadow banks have far more leeway in hiding and obscuring soured loans and credits. And one of the techniques is called selective defaults, which I pointed out that S&P categorized as both rising and as being quite concerning. I almost never do ads, and I say no to the vast majority of those that are brought to my attention, but I was thrilled to be able to work with today's video sponsor, Monetary Metals. And the reason is because they're solving a big problem, one that I've been highlighting for a very long period of time. Gold is a safe haven, but other than sitting in a vault, it doesn't do anything. Monetary Metals fixes that. They let you earn real yield paid in physical gold without giving up ownership. It's not a fund, it's not a paper claim, it's your gold working for you. Every month, more gold gets deposited into your account. It's simple, it's transparent, and it is fully insured. If you believe in gold as a long-term store of value as I do, this changes everything. Go to monetary-metals.com/Snyder. That's monetary-metals.com/Snyder for all the details. We absolutely thank them for being the sponsor of today's video. And now let's get back to it. Valuation firm Lincoln International went even farther, was even more explicit, though it did stop short of calling anyone a cockroach. But to quote Lincoln, the use of payment in kind interest may be a better indicator of stress. Lincoln saw that PIK interest is present in 11% of all deals it values, and of those deals, 53% had bad PIK, which was defined as not elected or available at the close, but is now being utilized. This translates to a shadow default rate of 6%, which may be more indicative of the health of private credit. And this rate is further corroborated by the fact that the average loan to value for companies with bad PIK was 45% at inception compared to an average 83% today, a clear sign of stress. This current shadow default rate of 6% compares to just 2% back in 2021. And remember, this is all before the forgot how to hire economy truly started to shift toward remembering how to fire along the flatter part of the beverage curve. Even the ever optimistic stock market has soured on these private credit companies, starting with the business development companies like Blue Owl. Now, these BDCs that Jamie Dimon referenced are just the publicly traded versions. And those share prices overall, now they were down with the market into March and April, but then they bounced back with stocks through May and June and into the start of July, which is a timing we keep coming back to all over the place. From mid-July onward, however, shares of these BDCs have sank pretty solidly, which is timed to right around when the bond market shifted, the US dollar turned around and moved higher that we've already talked about, the Eurodollar tightening, and now here's consistent with all that, we see a downturn in BDC share prices. Now, one reason that those stocks are sinking is lower interest rates themselves. Most private credit, or a ton of it, is floating rate, which means as rates go down in the marketplace, less interest income is coming in. Therefore, the BDCs are going to have to cut their dividends, and many of them already have. In fact, last month, Blackstone's gigantic private credit fund was the first to do so, and then it was quickly followed by more, including Oaktree's Strategic Credit Fund and several others beside. But lower dividend payments on their own don't explain the backlash in the otherwise soaring stock market. Going back to Bloomberg, Jonathan Lamb, who's the chief financial officer of Blue Owl BDC, said the firm is, quote, completely flummoxed by the BDC sell-offs, noting the stock price does not reflect the strong credit performance of the fund. We think that we are mispriced from a sector perspective, he said in an interview, and the only reason that the sector should be trading off like this is if there is a massive amount of credit defaults coming, which of course, Mr. Lamb says, we see no evidence of. And maybe that's the answer. He sees no evidence, and she's certainly not going to say that he sees any evidence, but maybe the market is starting to think the environment overall is looking like it will lead to a situation where that will be the case. He doesn't see it. More and more we see the background behind it, and it's even catching up to all these BDCs in the stock market that is otherwise soaring. And that last part that Lamb was talking about sounds quite a lot like the cockroaches Jamie Dimon was speaking of, alongside with being a little touch of Lady Macbeth here. The Blue Owls of the world seem to be protesting a little bit too much and a little bit too loudly, given the overall synchronized turn everywhere in all these different markets. Now, Blue Owl and his BDC and other shadow bank peers are going to continue to say their credit quality is fine. We expect nothing less from them. But those protestations are falling on deaf ears as the macro and money world around them no longer wants to hear it. And the reason is flat beverage. Now, appearing in Philadelphia yesterday, Federal Reserve Chair Jay Powell was, of course, asked for his latest take on economic circumstances, and his answer was exactly describing the beverage curve and its shift to the flat part. right down to the two series that make up the graph's axis, even if he didn't specifically invoke Beveridge's name. But it doesn't matter. What he said leaves zero doubt. Going to Powell here. You're at a place where further declines in job openings might very well show up in unemployment. You've had this amazing time where you came straight down, but I just think you're going to reach a point where the unemployment starts to go up. And that second sentence is exactly the flat part of the Beveridge curve that we've been talking about, meaning the Fed chair, Mr. Tariff Inflation, is now staring into a strong possibility of that exact transformation and transition to flat Beveridge. So, for one thing, continuing the line of thinking in private credit and these business development companies, the Fed is going to get further out of the way of the market by cutting short-term policy rates. It's a done deal for at least the rest of the year. And those lower policy rates not only mean weaker dividend potential for those BDCs and their stocks, they also mean more confirmation of the weak economy that would potentially lead to the massive amount of credit defaults coming that Blue Owl's Jonathan Lamb said there is no evidence for. Maybe no evidence currently from the BDCs and private credit providers for the reasons I talked about it just a few minutes ago. As far as the evidence for the macroeconomic and monetary background, which would be fertile for cockroach scattering, for that, we are getting tons of evidence and confirmation of increasing confidence and even intensity. And one of the most powerful signals comes from the oil market and oil futures. We got contango on the WTI curve for the first time in several years, which I talked about in yesterday's YouTube live video, which is a powerful signal. Even though some people like to downplay contango as just another natural structure of the WTI futures curve, or any oil futures curve, or any futures curve for that matter. But in terms of WTI and oil, contango shows up when the global economy is experiencing a major downturn, as well as monetary difficulties that go along with it. And yes, the mainstream makes it all about the supply side of a supposed supply glut, but look at the timing when supply glut contango shows up. Each and every time, save the one I talked about yesterday, the world is experiencing major contraction and deflationary money beside it. The kinds of conditions that you don't want to see if you're an investor exposed to the kind of debt stuffed away into the shadowy portfolios of these shadow banks. But we go beyond WTI contango. Just look at the two-year maturity from around key bond markets, starting with U.S. Treasuries. The two-year Treasury had been trading basically sideways for several weeks throughout September, when September usually pushes yields higher. That's the September effect that we always talk about. It has been stuck around 360, but then this week falling down into the 340s and threatening with another major push to hit another multi-year low, further confirming the bull steepening that everyone had previously mistaken for Treasury rejection, sell America, tariff inflation, or a bunch of other ideas that never really had any basis. I mean, tariff inflation, even Jay Powell's given up on that. And this isn't really about the latest trade war developments either. Treasury's two-year maturity, the yield on it, has been moving pretty solidly downward since February, all throughout the Treasury rejection and tariff inflation summer of waffling Fed policymakers. And it has been quietly doing its bull steepening part this entire time. And maybe more important than the Treasury two-year, Germany's two-year, or the Schatz's. The yield there sunk to around 1.9% today, and it is beginning to look like the German twos are rolling over again into what would be its next downward step. Now, going all the way back to the beginning of the global bond rally in October 2023, and in fact, the rally really started for the shots the month before in late September 2023. But either way, look at how the pattern repeats. German twos go down in very stepped fashion. They drop pretty sharply for a couple months, and then they pause for multiple months at a time. The rates go back higher, sometimes significantly higher, all the while the mainstream says the market has changed its mind. It's moving back closer to central bank positions, yada, 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 yada. And then, unexpectedly, the two-year begins to move down into its next downward step, and the process repeats all over again. Now, the last step for Germany's twos was back into April, with the shots last reaching a low around April 21st. And then over the next 5 months through the summer, the yield moved slowly but steadily higher, which at first, for the mainstream, seemed to be consistent with Christine Lagarde and the ECB saying they're close to done, if not done, cutting interest rates. In fact, that's what ECB policymakers said basically last month. But over the past couple of weeks, as you can see, the market has made an increasingly clear turn that increasingly looks like it is instead the next downward step in the German bull steepening process. And since these markets are pretty globally synchronized as it is, this next step down, if that's what we're seeing, isn't really about Germany at all, nor is it really about trade wars because it started before we even got the latest announcement from China and the US. And non-local factors, those are definitely the case for the Swiss market. Again, using the 2-year maturity. Those have been negative ever since the first week in April and vacillating back and forth over the months since then. Just this week, the 2s in Switzerland have sunk even deeper into the negatives, with the yield today reaching minus 17 basis points. At the same time, importantly, the 10-year in Switzerland has been moving significantly lower as well. But then there's this massive move in gold, which has it over $4,200 per ounce today, and it has nothing to do with inflation. It also has nothing to do with this ridiculous idea of debasement that's floating around everywhere, especially in crypto, that is trying desperately to justify why Bitcoin trades like Nvidia. Now, as I've shown you repeatedly, gold does poorly during reflationary periods such as those in 2021 and 2022, even as the CPI was at its highest rates. Gold sucked during what everyone wrongly calls inflation, and it stopped sucking once forgot how to grow started to materialize. And gold again soared late last year and early this year. Why? The deflationary conditions in the Eurodollar erupted, and then gold paused through the summer months when many financial markets like stocks were heavily re-risking on the belief that everyone was going to be just fine, since the trade wars in March and April didn't immediately lead to the total and complete collapse of all Western civilization. But once it became increasingly clear that instead the flat beverage was going to prevail, from the middle of August forward, amidst all these growing deflationary money signals, gold has gone crazy. Right as yields have depressed, the dollar is going back up, and now even contango and WTI. And if you had the least little doubt left about what the gold signal really means, just put it together with copper. Even as copper prices have been strengthening on pretty dramatic supply problems, sitting at just shy of $5 per pound at the CME, gold's even bigger move has clipped the copper to gold ratio down to a new and frankly mind-boggling record low. That's not just a deflation signal, that's as confident of one as we've ever seen. Why? Because for once, maybe Jamie Dimon is correct, and maybe he does have the ability to spot cockroaches, even if he doesn't have the ability to understand inflation. They call it private credit for a reason. Private credit firms, get this, tell us they're just fine, and they see no reason for anyone to think otherwise because, of course, no one would be so foolish as to chase riskier returns in a period of less than ideal circumstances. It's just like the Fed telling us the economy is fantastic. Policymakers aren't going to say anything else, and of course, private credit firms aren't going to say anything else either. Except when conditions deteriorate more than enough, policymakers anyway really can't keep up the facade any longer. Powell went from tariff inflation to flat beverage in the span of just the last couple months. These same few months when we've had all of these market signals more strongly, more confidently pointing to a flat beverage economy. And if that does turn out to be the case, then you really will have the roaches scattering looking for the exits. I mentioned the video I did last month on private credit, where it came from and everything that's going on with it, especially the ability to obscure losses, all in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.